Okay, so welcome to the deep dive, everybody. You're here with us today because you want to really understand what's going on with the economy right now. Specifically, those Trump tariffs they were rolled out just recently, April of 2025. It's been all over the news, obviously, and you're probably wondering, what does it all mean for me?
Well, that's exactly what we're going to try to break down today in this deep dive.
Yeah, we're going to look at this from two key angles. I
Yeah.
think first we'll try to get into how these tariffs, might be directly impacting how you spend your money every day.
Hmm.
And then second, we'll kind of dig into how did the financial markets react?
Yeah.
And what are some experts suggesting in terms of, how to sort of navigate this uncertain period
Yeah,
these kinds of events can create?
exactly. And just to be super clear from the get-go, this deep dive is about understanding the economic realities based on, what's actually happened. We're not offering any political commentary here.
Yeah.
This is just to kind of give you a clear picture of the situation as it unfolded. Okay, so let's dive in.
What exactly are these Trump tariffs of April 2025 that everyone's talking about?
Well, the big move happened on April 2nd, 2025.
Hmm.
That's when the Trump administration put in place two significant tariffs. The first was a 10% tariff on pretty much all goods coming into the U.S.,
Okay.
and then there was a much larger 34% tariff,
Oh, wow.
specifically targeting goods imported from China.
Okay, so what was the idea behind these? What was the rationale that was being presented?
Yeah, well, the Trump administration's main argument was centered around the idea of strengthening America's economic independence
Mhm.
and national power.
Okay.
So the goal, as they presented it, was to encourage more American companies to produce goods here at home
Right.
and for Americans to buy those, domestically made products.
Yeah.
They also specifically stated that these tariffs were a way to push back against what they saw as, unfair trade practices, particularly from China.
Mhm.
President Trump himself reportedly referred to it as a kind of liberation day for fair trade, with the aim of bringing back manufacturing jobs to the U.S.
And this wasn't just China, was it, that was affected by these new tariffs?
No.
I recall hearing about several other countries being impacted as well.
Yeah, you're right. So starting a little bit earlier in March of 2025,
Mhm.
tariffs had already been implemented on a number of other trading partners.
Okay.
So Canada, for instance, faced a 25% tariff on the majority of their imports, um, although energy products had a slightly lower 10% rate.
Mm.
Mexico also had a 25% tariff imposed.
Okay.
Beyond North America, there were quite significant tariffs on countries like Bangladesh, hitting their garment exports with a 37% tariff, Taiwan at 32%, and even some smaller economies like Lesotho facing tariffs as high as 50%.
Wow.
So there's a pretty broad set of
It was
actions.
a very wide net.
Right.
And it's probably no surprise that these countries didn't just stand by. What was the reaction, especially from a major player like China?
Right. So China's response was pretty immediate and pretty forceful.
Mhm.
They announced a matching 34% tariff
Mm.
on all goods that the U.S. exports to them.
Okay.
This directly affected a huge amount of trade. I mean, we're talking billions of dollars in goods,
Yeah.
and really targeted, some key sectors of the American economy that rely heavily on selling their products to China.
Yeah.
So think about, soybean farmers, companies that manufacture tech hardware,
Right.
and even the automotive industry. Like, they all felt the immediate impact.
So let's talk about how this actually impacts consumers. So when you say tariffs, what we're really talking about is essentially a tax on imported goods.
Right.
So how does that actually translate into, changes you might see in your day-to-day spending?
Well, when a tariff is slacked on a product coming into the country, it makes that product more expensive for the companies that are importing it.
Right.
Now, those companies aren't usually going to just eat that extra cost.
Of course.
More often than not, they're going to pass at least some of that increase along to you, the consumer. And because the U.S. imports so much, particularly from China,
Yeah.
for such a massive range of things we buy, we're likely to see prices creep up across a lot of different categories.
Could you give us a clearer picture of the types of things that might become more expensive because of these tariffs?
Yeah, sure. So think about your electronics,
Yeah.
your smartphone, your laptop, your television. A lot of those components and often the finished products themselves are imported.
Yeah.
Same goes for a lot of machinery and industrial parts,
Mm-hmm.
medical equipment,
Right.
the clothes and shoes you wear,
Sure.
textiles for your home,
Mm-hmm.
furniture,
Makes sense.
and just general household goods.
Yeah.
To give you some scale, back in 2024, the U.S. imported over $530 billion worth of goods from China alone.
Wow.
So a 34% tariff on that volume has a very real potential to push up the prices on a significant portion of what American households buy.
That sounds like it could really start to add up for the average family. Do we have any estimates on what kind of financial hit this could mean for, folks like you listening right now?
Yeah, so there are some estimates, although they vary. Some economists were predicting that these tariffs could translate to an extra cost for American households, ranging anywhere from around $1,700 to potentially as much as $5,000 per year.
Wow.
There was another figure circulating that suggested an average annual increase of about $3,800 per household.
Okay.
Now, these are substantial amounts that could definitely put a strain on household budgets.
Yeah. Beyond just the price tags, I imagine, this kind of economic uncertainty can also affect how people feel about spending in general, right?
Absolutely. Consumer confidence is a big factor in the economy.
Yeah.
And we saw a clear dip in how confident people felt about the economic situation following the announcement of these tariffs. Both the Conference Board and the University of Michigan, which track consumer sentiment through surveys, reported drops in their indices to levels we hadn't seen for a while.
Oh.
The Conference Board index fell to its lowest point since early 2021, and the University of Michigan's index hit lows not seen since late 2022.
Okay.
When people are less confident, they tend to be more cautious about making purchases, which can have a broader impact on the economy.
Okay. So we're seeing, potential price increases on a lot of everyday goods. We're seeing a drop in consumer confidence.
Right.
What was the immediate reaction in the financial markets to all of this? I remember hearing about a pretty significant downturn.
The financial markets definitely reacted strongly and swiftly.
Yeah.
On April 3rd, 2025, the day after the main tariffs were announced,
Mm-hmm.
the stock market saw a very significant drop. So the S&P 500, which is a broad measure of the performance of large American companies,
Right.
fell by 4.8%.
Okay.
That was his worst single-day performance since 2020.
Wow.
The NASDAQ composite, which is heavily weighted towards tech companies,
Yeah.
took an even bigger hit, dropping by 6%, which was actually the largest single-day point loss in its history. And the Dow Jones Industrial Average, another key market indicator, plummeted by nearly 4%, or 1,679 points, closing at 40,546.
Wow.
In total, the Dow had seen a fall of over 2,200 points
Okay.
due to the broader announcements around tariffs.
Those are some pretty eye-popping numbers. What was causing that kind of sharp reaction from investors?
I think the main driver was uncertainty.
Okay.
Investors don't like uncertainty.
Yeah.
And these tariffs injected a lot of it into the economic outlook.
Yeah.
There were concerns about what these policies meant for future trade relationships, the potential for disruptions to global supply chains,
Right.
meaning how goods get from where they're made to where they're sold,
Yeah.
and the very real possibility of a prolonged economic standoff between major economic powers like the U.S. and China.
Mm-hmm.
All of that creates worry about future profits and economic growth.
And this wasn't happening out of the blue, was it?
No.
The market had already experienced some volatility earlier in the year.
That's right. So if we look at the performance for the year up to that point, as of the end of March 2025,
Mm-hmm.
the S&P 500 was already down by about 4.6% for the first quarter of the year.
Okay.
And looking back a bit further,
Hmm.
it had also fallen by around 3% since November 5th, 2024. So the market was already facing some downward pressure.
Yeah.
And these tariff announcements definitely intensified that negative feeling among investors.
We've talked about sort of the broad market drops, but were there any specific industries or sectors that were particularly hard hit by this news?
Yes, so several sectors felt the impact quite significantly. In the automotive industry, Jaguar Land Rover actually made the decision to halt shipments to the U.S.,
Wow.
specifically citing existing auto tariffs as a contributing factor. The tech sector also saw major declines in the stock prices of big companies like Nvidia, Tesla, Amazon, and Microsoft,
Right.
as investors anticipated, higher costs for imported components
Yeah.
and potentially lower demand if consumer spending slows down.
Right.
And in agriculture, there were serious concerns, especially among soybean farmers, about a potential collapse in demand from China,
Yeah.
which is a huge market for U.S. soybean exports,
Yeah.
as well as for beef and grain.
So, given all this market turbulence, what were financial experts saying? What kind of overall picture were they painting, and what advice were they offering to people about their investments?
Yeah, so the general outlook from financial experts became more cautious, understandably.
Yeah.
For instance, Goldman Sachs predicted that the S&P 500 could potentially fall another 5% over the following 3 months.
Wow.
And they also lowered their expectations for how much companies' earnings per share would grow in 2025.
Okay.
Yardeni Research went a step further, increasing their assessment of the chances of stagflation.
Okay.
That's a situation where you have high inflation at the same time as slow economic growth.
Right.
And they even raised the possibility of a mild recession.
That certainly sounds like cause for concern for anyone with investments.
Right.
Were they suggesting that people should just sell off all their stocks to avoid further losses?
Well, it's interesting. The prevailing advice was actually against making such drastic moves as selling all your stocks based solely on these immediate market reactions.
Okay.
Experts emphasize that the stock market is inherently prone to ups and downs,
Yeah.
and that trying to perfectly time the market,
Right.
meaning trying to guess the exact right moment to sell and then buy back in,
Yeah.
is generally a very difficult and often unsuccessful strategy, even for professionals who do this for a living.
So if unloading everything isn't the recommended approach, what kind of investment strategy were they suggesting for navigating this kind of uncertainty?
Well, the consistent recommendation was to maintain a well-balanced and diversified investment portfolio.
Okay.
So to give you an example, for someone in their 60s, the advice might be to have somewhere between 30% to 50% of their investments in stocks,
Okay.
with the rest spread across more stable assets like bonds and cash. T. Rowe Price, a large investment firm, even offered a more detailed breakdown of the stock portion of portfolio,
Okay.
suggesting a focus on U.S. large-cap stocks with smaller allocations to U.S. small-cap companies, developed markets outside the U.S., and emerging markets.
Okay.
The key is not to have all your eggs in one basket.
Right.
Right,
That makes sense, spreading out your risk across different types of investments.
right.
But what about people who are already retired and relying on their investments for income? Should they still have some exposure to the stock market?
Yes, even in retirement, it's generally considered important to have some portion of your portfolio invested in stocks.
Okay.
This is because stocks tend to offer higher potential for growth over the long term, which helps to keep your savings ahead of inflation
Right.
and potentially provide income down the line.
Yeah.
However, because retirees may need to access their funds more readily for living expenses,
Right.
it's typically recommended that they balance their stock holdings with a larger allocation to more conservative and stable assets,
Yep.
like bonds and cash, which can provide more predictable income and help to buffer against short-term market downturns.
You mentioned that trying to time the market is generally not a good idea.
Right.
Could you explain a bit more about why that is, especially in the context of these Trump tariffs and the market reaction?
Yeah. Think back to the very beginning of the COVID-19 pandemic.
Mm-hmm.
The stock market experienced a very sharp and rapid decline in early 2020
Right.
as the health crisis unfolded and there was a lot of fear and uncertainty.
Right.
However, what many people might remember is that the market actually bottomed out
Yeah.
and began a strong recovery, even while the number of COVID-19 cases was still rising significantly around the world.
Yeah.
Many investors who panicked and sold off their investments during that initial drop ended up missing out on the subsequent swift and substantial recovery.
Mm-hmm.
The situation with these tariffs could potentially play out in a similar way.
Yeah.
While the initial market reaction was negative, any number of factors could shift the outlook.
Right.
Perhaps a change in trade policy, successful negotiations between countries, or even companies finding ways to adapt to the new tariff environment.
Right.
Trying to predict exactly when that turning point will occur is extremely difficult.
Yeah.
And many investors who try to time the market end up buying high and selling low,
Right.
which is the opposite of what you want to do.
Exactly. So if trying to predict the market's next move is so risky, what would you say is a more sensible approach for investors who are feeling uneasy about the current economic climate and these tariffs?
Well, a strategy known as dollar cost averaging, or DCA, is often recommended during times of market volatility and uncertainty.
Okay.
This involves investing a fixed amount of money at regular intervals.
Okay.
For example, $100 every month.
Right.
Regardless of what the market is doing,
Okay.
this approach helps to take some of the emotion out of investing
Right.
because you're not trying to guess whether now is the right time to buy.
Right.
When stock prices are lower, your fixed investment amount buys more shares. And when prices are higher, it buys fewer shares.
Makes sense.
Over the long term, this can help to smooth out your average purchase price
Right.
and encourages a disciplined, long-term approach to investing.
Mm-hmm.
The key takeaway here is that selling out of your investments based on short-term market statistics is generally not a wise long-term strategy,
Yeah.
as you risk missing out on potential fast recoveries, much like we saw after the initial shock of the COVID-19 pandemic.
Mm-hmm.
Dollar cost averaging can be a much more effective way to navigate these uncertain times.
This has been a really insightful breakdown of a complex and evolving situation.
Thank you.
To bring it all together for you, the listener, what are the most important things to keep in mind regarding these Trump tariffs and their potential impact on your financial life?
Well, the key things to remember are the significant scale of these tariffs,
Mm-hmm.
affecting not just goods from China, but from many of our trading partners, which has led to the potential for increased prices on a wide array of consumer goods and a noticeable dip in consumer confidence.
Right.
The financial markets reacted sharply to the uncertainty these tariffs created,
Yeah.
with significant single-day drops.
Mm-hmm.
While financial experts are generally cautious about the near-term economic outlook and recommend maintaining a balanced and diversified investment portfolio,
Yeah.
the overall advice is to avoid the temptation of trying to time the market and selling off your investments based on short-term fluctuations.
Okay.
Instead, consider a disciplined approach like dollar cost averaging as a way to navigate this uncertainty and build wealth over the long term.
Okay, so as we continue to watch how these economic events related to the Trump tariffs unfold, it really underscores just how interconnected the global economy is and the potential ripple effects that policy decisions can have on our everyday lives and our financial futures.
Precisely.
And that brings us to the end of this deep dive. But before we wrap up, here's something for you to think about. Considering the potential for market volatility that we've discussed,
Right.
and the understanding that economic cycles play out over the long haul, how might embracing core investment principles like diversification and consistent investing, such as dollar cost averaging,
Yeah.
help you to weather these kinds of uncertainties
Right.
and stay on track towards achieving your long-term financial goals? It's definitely something worth pondering.
Indeed.
If you found this deep dive helpful and you want to stay informed with more in-depth discussions on financial topics and how they might affect you, please make sure to subscribe so you don't miss our next conversation. Thanks for joining us today.